Miami is having a strange kind of success. The skyline is getting taller. Luxury condos are getting more expensive. New restaurants keep opening. Money keeps flowing in. And yet, for the people who actually live and work there, something feels increasingly broken. A nurse can have a job in Miami and still struggle to afford a home near that job. A teacher can spend years building a career in the city and find that rent keeps moving faster than their paycheck. A construction worker can help build million-dollar apartments that he could never afford to live in. And that creates a strange question. How can a city become richer while becoming harder for ordinary people to afford? Miami gives us a surprisingly clear answer. Because this isn't really a story about Miami. It's a story about what happens when the price of owning a city rises much faster than the income required to live in it. And once you understand that mechanism, Miami starts looking less like an exception and more like a warning. For decades, Miami was known for beaches, tourism, retirement communities, and relatively affordable real estate compared with places like New York or San Francisco. Then something changed. Money started arriving from everywhere. Technology workers, investors, entrepreneurs, retirees, high-income professionals, international buyers, people moving from expensive states. And companies increasingly began treating Florida as an attractive place to operate. At first, this looked like a perfect economic story. More people arrive, more businesses open, more construction happens, more money gets spent, property values rise, tax revenue grows. The city becomes more valuable. But there's a catch. A city doesn't just sell luxury apartments. It also needs teachers, nurses, waiters, mechanics, delivery drivers, electricians, cashiers, police officers, construction workers. And those people need somewhere to live. That's where the economics starts getting uncomfortable. Imagine two people. One earns $50,000 a year. The other earns $500,000. If both want to live in the same city, they aren't competing on equal terms. The person earning 10 times as much can bid dramatically more for housing. And housing has one very unusual characteristic. You can't manufacture land in the middle of Miami. You can build more apartments. You can build taller buildings. But the desirable locations remain limited. So when more wealthy people arrive, they don't simply bring more money into the local economy. They also bring more purchasing power into the housing market. And housing prices respond. This is one of the most important economic ideas hiding underneath Miami's transformation. Prices don't care whether your salary feels fair. Prices respond to what buyers can pay. That distinction is enormous. Suppose a condo is worth $500,000. Then a group of wealthier buyers arrives. They're willing to pay $700,000. The property doesn't care that local workers are still earning roughly the same salaries. The market now has a new reference point. Suddenly, $500,000 looks cheap, and that higher price spreads outward. The expensive apartment becomes the benchmark. Nearby apartments become more valuable. Land becomes more valuable. Developers pay more for land. Construction projects become more expensive. And eventually, renters feel it too. This is where the story gets even stranger. Because rising property prices can make existing homeowners feel wealthier without making the city more affordable. Someone who bought a Miami house years ago might look at its current value and think, I made a fortune, and technically they may have. But that wealth exists partly because the next person has to pay more to enter the market. It's a peculiar form of prosperity. Your house becomes more valuable, but the house next door becomes more expensive too. So unless you're selling and leaving the market entirely, that paper wealth doesn't necessarily make your everyday life cheaper. In fact, it can make the next generation's life harder. And this is where Miami's wealth story collides with America's broader housing problem. For years, the country treated housing as both a place to live and one of the most important ways ordinary households build wealth. That worked reasonably well when homes were affordable relative to incomes. But when housing prices rise much faster than wages, the system starts splitting into two groups. People who already own assets, and people trying to buy them. The first group watches their wealth rise. The second watches the price of entry move further away. That's the quiet inequality hiding inside a housing boom. And Miami has another advantage that makes this story particularly interesting. Taxes. Florida has no state individual income tax. That matters because a high-income person deciding where to live doesn't only compare beaches. They compare the entire financial package. Imagine someone earning $5 million a year. Moving from a high-tax state to Florida can potentially change their tax bill by a very large amount. So Miami isn't competing only for tourists. It's competing for high-income residents. And when high-income residents move in, they don't arrive alone. They bring spending. They buy homes. They rent apartments. They open businesses. They hire workers. They invest. They consume. All of that can create genuine economic growth. This is important. The story isn't that wealthy newcomers are somehow bad for a city. They're not. Investment can create jobs. Construction creates employment. New businesses create opportunities. Higher property values can generate more economic activity. The problem appears when the benefits and costs don't land on the same people. A billionaire might spend millions on a condo. The construction industry benefits. The developer benefits. The real estate agent benefits. The local economy benefits. But the worker serving coffee downstairs still has to pay Miami rent. And his salary doesn't automatically rise just because the condo above him sold for $8 million. This creates what economists might describe as a mismatch between asset inflation and wage growth. But you don't need an economics degree to see it. Look at the building. One person owns the apartment. Another person cleans it. Another person maintains it. Another person delivers food to it. And all of them are living under completely different versions of the same economy. That's the irony. A city can generate enormous wealth while making the cost of participating in that economy increasingly expensive. And then comes the hidden bill. Insurance. Miami isn't just expensive because wealthy people want beachfront property. It also sits in one of the world's most climate-exposed real estate markets. Hurricanes and flooding create enormous financial risks. Insurance companies have to price that risk. When expected losses rise, insurance becomes more expensive, sometimes dramatically more expensive. And when insurance costs rise, homeowners don't simply absorb the cost forever. The expense gets built into the economics of owning property. It affects mortgages. It affects rents. It affects developers. It affects condominium associations. It affects whether a building remains financially attractive. So the price of a Miami apartment isn't just the mortgage. It's the entire cost of keeping that apartment economically viable. And that's something glossy real estate advertisements rarely emphasize. A $1 million condo isn't just a $1 million asset. It's a $1 million asset sitting inside a particular tax system, insurance market, interest rate environment, and climate risk zone. Change any of those variables, and the economics changes. This became especially important after interest rates rose sharply in the early 2020s. For years, cheap borrowing helped push asset prices higher. When money is cheap, investors can afford to pay more. When borrowing becomes expensive, the math changes. A property that looked attractive when financing was cheap can suddenly look much less attractive. But here's the strange part. Housing prices don't necessarily collapse just because affordability gets worse. Why? Because existing owners may refuse to sell. Developers may delay projects. Potential buyers may wait. And the number of homes available for sale can remain limited. So instead of prices immediately falling, the market can simply become frozen. Expensive homes, expensive mortgages, few sellers, few affordable options. Everyone waits. And meanwhile, renters are still paying. This is why housing crises can feel so different from stock market crashes. Stocks can fall 20% in a few weeks. Housing is slower, more emotional, more political, and far more connected to everyday life. You don't live inside your stock portfolio. You live inside your house. That's why Miami's story matters beyond Miami. Because the underlying mechanism is appearing in cities across America. When capital concentrates in desirable places, when housing supply struggles to keep up, when high-income workers compete for limited homes, When investors treat property as an asset, and when wages don't rise at the same speed, the city can become wealthier on paper while becoming less affordable in practice. And that creates a dangerous illusion. From the outside, everything looks fantastic. New towers, luxury stores, restaurants, private jets, record property values, expensive cars, construction cranes everywhere. It looks like prosperity, and it is prosperity for some. But economic health isn't measured only by how expensive the most expensive apartment becomes. It's also measured by whether the people who keep the city functioning can afford to remain there. Because eventually, the economy runs into a simple physical problem. Workers have to live somewhere. If teachers can't afford to live near schools, if nurses can't afford to live near hospitals, if service workers can't afford to live near restaurants, if construction workers can't afford to live near construction sites, the city begins importing labor from farther away. Commutes get longer. Traffic gets worse. Workers spend more time traveling. Families have less time. Transportation costs rise. And the city becomes increasingly dependent on people who live somewhere else. That's a strange version of prosperity. The city gets richer, while the people powering that wealth are pushed farther away from it. And there's another uncomfortable question. Who actually benefits when a city becomes dramatically more expensive? If you already own property, rising prices can look wonderful. If you're a developer, higher land values can create enormous opportunities. If you're a high-income newcomer, Florida's tax structure can be attractive. If you're an investor, Miami real estate can look like a way to participate in the city's growth. But if you're 25 years old and earning a normal salary, the same boom can look completely different. You aren't watching your asset appreciate. You're watching the down payment get bigger. You're not celebrating higher property values. You're calculating rent. You're not thinking about portfolio returns. You're wondering whether you can stay in the city where you built your career. And that is perhaps the biggest lesson Miami offers. Economic growth and affordability are not the same thing. A city can attract billions of dollars and still have a housing problem. It can create thousands of jobs and still leave workers struggling. It can become a global destination and still become increasingly difficult for ordinary residents to remain. The real question isn't whether Miami is becoming richer. It clearly is in many ways. The question is, richer for whom? Because if the price of entering a city rises faster than the ability of ordinary workers to pay, eventually the city starts becoming a luxury product. And luxury products don't have to be affordable to succeed. But cities do. That's the contradiction Miami is now testing in real time. Can a city keep attracting enormous amounts of wealth without pricing out the people who make that wealth possible? Maybe new construction solves part of the problem. Maybe wages eventually catch up. Maybe migration slows down. Maybe technology changes where people work. Or maybe housing simply becomes an increasingly valuable asset owned by fewer people, while everyone else pays rent to participate in the same economy. And if that happens, Miami won't just be an expensive city. It will be a preview of what happens when the economy gets very good at creating wealth, but much less good at creating affordable places for people to live. Because the strangest thing about Miami's boom isn't that some apartments cost millions of dollars. It's that a city can become incredibly valuable and still struggle to answer one very basic question. Where do the people who keep it running actually get to live?